Hey you, why is money something worth? Because we think that we will receive something from others in return for our coin or the bill that we have. But this is just a collective trust in money. As soon as we lose the trust that this money is something worth, it isn't. But what if we determine by law that the value of money actually has the value of a certain other good, like gold? Let's find out. Before we start, I need your help. I already published a few videos, which are the first that I have ever made, and I'm still learning a lot about editing, voice recording, and how I can present these topics to give you better content. If you're interested in economics and economic history, please subscribe to my channel, leave a like, give me some love in the comments, share this video, and also let me know in the comments below what other topics I should cover for you in upcoming videos. With that out of the way, let's go back to the video. In the last years, multiple countries bought huge amounts of gold. Turkey, Russia, and even the Philippines. But also, for private investors, gold is always seen as something as a safe haven. Especially for the countries buying gold and other precious metals, it helps to stabilize its currency. The first time this was the case was in 1816 in England during the burst of the so-called South Sea Bubble, when the banknotes should be covered by a certain amount of gold. In fact, the citizens had the right to trade their bills for gold in a given ratio. This was the first de facto gold standard. As Great Britain was the leading economic power at this time, many other countries followed soon after. During the 19th century, the gold standard helped to widen the international trade, as the wide use of the gold standard helped to fix the exchange rates and therefore made it easy to calculate between different currencies as they had a fixed value of gold. The gold standard had two primary benefits. First, due to the fixed ratio from money to gold, the trust into currencies was higher, as the amount of money was always fixed to the gold reserves of the Federal Reserve. Second, as multiple countries used the gold standard, the Federal Reserves of these countries were meeting on a regular basis to discuss topics of international trade and relations and to adjust the system. Therefore, the gold standard established a system of international cooperation for financial policies. This international cooperation was ended by the First World War. As the 20s and 30s of the 20th century were heavily influenced by economic crisis, the countries were focused to fight the economic crisis on an individual level and with their own means, and they did not want to collaborate on an international level at that time. Another try to establish a widely used gold standard was undertaken in 1933 on the London Economic Conference, on which 66 countries participated. But the American President Franklin D. Roosevelt was against the proposal, and therefore the international economic relations did not recover during the 30s of the previous century. After the Second World War, a new order of the world under the leading role of the USA took place. The Conference of Bretton-Woods shaped the economic world as we know it today. As the founding of the International Monetary Fund, the World Bank, and the General Agreement on Tariffs and Trades, also known as the GATT, which basically is the predecessor of the World Trade Organization, were agreed on. This had a tremendous impact on fiscal policies as the exchange rates were fixed again. But the dollar was now the most important currency worldwide, and the dollar was the only currency which had the gold standard. The other currencies, however, like the British pound, were fixed with their exchange rate to the dollar. However, in this system, it was still common to adjust the exchange rates of other currencies. The capital flows were, however, strongly regulated. The companies and private players needed permission from the government for importing and exporting capital. For 2 decades, the economy was thriving. For quite a while, no major financial or economic crisis happened. The banking authority usually were regulating very strictly, and high debt positions within the countries were not created. So, sounds very great, doesn't it? But what happened that this system is not in place nowadays? Well, the national debt was increasing rapidly in the USA. Especially due to the Vietnam War, the US needed a lot of money and therefore loosened its fiscal policy. This, of course, led to high inflation, which therefore undermined the trust into the dollar, and with this, the willingness to have fixed exchange rates to the dollar. A major pillar of the Bretton-Woods system therefore started to crumble. In 1971, the gold standard was finally abolished by Richard Nixon. There was no right to receive a certain amount of gold for your bills anymore. The gold market was set free, and with the end of the gold standard, the capital market as well. Without the Bretton-Woods system, the banks were allowed to do their business again worldwide. So there we are in our times. The international banks and the financial institutes are as relevant as there is a free market for the business, meaning more business for them, more money being earned, and more political influence. For private persons and companies, however, does the system, however, mean that they have an exchange rate risk, meaning due to the fluctuation of the exchange rates, the prices of the sold or bought products can change tremendously. To be secured from this risk, the companies have additional costs, and therefore the risks are handled privately. Within the Bretton-Woods system, this risk was handled by the individual states. In general, this boosted further the American economy as a lot of people invested in the US in search for the best return on their investment. Also, most countries are holding reserves in US dollars. Since the liberalization of the flow of capital, a lot of countries experienced heavy financial crisis, as for example Argentina, Brazil, and Mexico even twice, as well as the Asian financial crisis, which impacted a whole region. A big chance for the free flow of capital is that, for instance, developing countries can invest with credits into their own development and start infrastructure products which were not possible before, especially if these are long-term credits. Also, the number of foreign direct investments can increase as companies can directly invest in other markets without depending on the government allowing the investment. Difficult can be the hot money, short-term debts with high fluctuation of exchange rates. This was especially during the Asian financial crisis the case, when in the end the credits which were noted in dollar were difficult to pay back. In general, I prefer having a free financial market as the Bretton-Woods system was heavily dominated by the US. However, as mentioned before, this has also the risk of high fluctuation. It is not as stable as a heavily controlled market, and it also leads to a higher influence of the financial market. But I don't know. What do you think? Do you think the financial market should be regulated a little bit more strict? And if so, why and in which regard? Let me know in the comments below. Leave a like, subscribe, and also watch my other videos. And I'll see you in the next one.